Look at the Apple daily on your screen. Even the most liquid U.S. names can swing hard when the Fed cycle turns or earnings miss. A fat dividend yield is not automatically a good signal. Zero commissions do not mean zero tax. And chasing 2x returns on margin can become 2x losses or a foresell at the worst print. Those traps show up in real portfolios. Dividend traps, surprise tax bills at filing time, and margin calls during a panic. Today we walk through the traps U.S. stock investors fall into most often on the chart and how to prepare before they hit. We finish with a 12-point checklist. At the end, compare it to your own portfolio. Look at the 4 daily on screen while we clear up the biggest tax myth. In a taxable brokerage, U.S. stock profits are usually capital gains. They are not magically tax-free just because your app shows a zero commission. Example, buy $5,000 of stock and sell at $10,000. That roughly $5,000 long-term gain can still face a common federal rate band around 15% or 20% depending on your bracket, plus any state tax. Inside a Roth IRA, qualified withdrawals of growth can be federal tax-free if you meet the rules. That contrast is the whole point of the account type. Do not relax yet. Dividends are separate. Qualified dividends in a taxable account are still taxed in the year you receive them. So when you chase a high-yield name, first ask, what is my after-tax cash yield really? Second, U.S. equities do not carry a Korean-style 0.2 stamp tax on every sale, but tiny SEC and FINRA activity fees still skim pennies to dollars, and short-term flips can push gains into ordinary income rates. Sell $10,000 10 times a month, and the friction plus tax drag adds up fast, like a $3 coffee that becomes $4.50 if you buy it twice a day. Third, margin interest is still charged. Retail rates often sit in the high single digits to low teens annually. The bigger the borrowed balance, the faster the interest bill grows. Confirm your broker's rate before you flip the switch. Look at the SPY weekly on screen. This S&P 500 most global investors use as a market thermometer. The U.S. market is huge versus many countries, but size alone does not mean diversification. What does that mean in practice? A few very large fish can still stir the whole pond. When a handful of mega caps dominate the index weight, their earnings and news become the market. In recent mid-2020s periods, the top names, think Apple, Microsoft, Nvidia, and a few peers have often accounted for a large slice of S&P 500 market cap. Exact weights shift month to month. The structure is the point. So when those leaders rise, headlines say the market is up. When they fall, the market is down. That is concentration risk. Diversity on paper, concentration in practice. Analysts call this concentration or top-heavy weighting. The higher it runs, the more one company's results can swing the whole index and your SPY-like portfolio with it. Look at a high-beta growth name like Nvidia on the daily while we talk dividend traps. A stock advertising a 10 to 20% yield will catch your eye, should it? Remember the formula. Dividend yield equals dividend divided by current price. If the annual dividend stays at $1, but the stock falls 50%, the yield doubles. That is rarely good news. It often means the company just got riskier. It is the same intuition as a distressed bond, yielding more because default risk rose. Rising yield after a crash is often the price collapse talking. On the chart, you frequently see yield climb only after a deep drawdown. Worse, the dividend itself can be cut or suspended. When earnings and free cash flow weaken, boards slash the payout, and the income story evaporates overnight. When you screen dividend names, Do not stare at the yield number alone. Ask, is the company still earning consistently? Is cash flow enough? What do the last 3 years of results look like on the chart? A fat yield can be a warning light, not a gift. Stay on the 4 daily while we unpack margin. Margin means your broker lends you cash so you can buy more stock than your own equity alone would allow, under Reg T and your firm's house rules. Example, with $1,000 of your own cash, you might control about $2,000 of stock under a classic 50% initial margin, and aggressive setups push buying power higher. A 20% rise can look like a huge percentage gain on your equity. A 20% drop can wipe that equity out. Keep falling, and you can lose more than you put in. The sharper concept is maintenance margin. If the stock drops hard, say on the order of a 30% slide, your broker can issue a margin call and demand more cash within a short window. Miss it, and the firm can force-sell your shares without your consent. That often hits during market panic. Worse price, worse timing. If you use margin at all, keep the position small and pre-commit a hard stop. For example, exit immediately if your initial equity is down about 5%. Hold past that, and a maintenance breach can snowball losses far past what you planned. Because the U.S. index can be top-heavy, diversification is not optional. An S&P 500 fund like SPY on this weekly chart is a start. You can also diversify on purpose inside and outside the index. First, diversify by size. Mix large caps, mid caps, and smaller names, so one megacap earnings miss does not define your whole month. Second, diversify by sector. U.S. indexes lean toward technology and communication services in many periods, so utilities, healthcare, consumer staples, and financials can keep one industry shock from wrecking the whole book. Third, mix domestic and international. U.S. volatility still bites. A measured sleeve of international or developed market companies, often cited in the 20 to 30% range of a long-term portfolio, can act as a partial hedge. Exact weights are your decision after you check the latest data. Finally, use tax-advantaged wrappers wisely. A 401k, traditional IRA, or Roth IRA. Contribution limits and withdrawal rules apply, and the tax benefit depends on the account type. Use them strategically and recheck IRS guidance before you fund. With the 4 daily still on screen, here is a 12-point checklist to run before you put real dollars to work. 1. Do not judge a name by dividend yield alone. Check payout ratio and free cash flow so the dividend looks sustainable. 2. If you use margin, exit as soon as your initial equity is down about 5%. Hold longer, and a maintenance call can double or triple the damage via forced liquidation. 3. If one position is more than about 20% of the portfolio, concentration risk jumps. 4. If yield prints above roughly 8%, pause first. Is the company healthy, or did the price just collapse? 5. In a taxable account, capital gains and dividends are usually taxed. Commissions being zero does not erase that. 6. Fund your 401k, IRA, or Roth within the rules and limits that apply to you. 7. When earnings weaken, the dividend is often the first thing at risk. 8. Against U.S. concentration and Fed cycle swings, consider a measured international sleeve, often discussed around 20 to 30% of a long-term mix, via broad effects. This lesson is for education only. Every investment decision and every loss is your responsibility.